Nikhil Sancheti, who is a partner with transaction advisory practice at Ardent Advisory and Accounting. Nikhil has 18 years of experience in corporate finance and private equity space, specializing in advisory assignments, business valuations, financial due diligence, business plans, and debt restructuring. Prior to joining Ardent, he worked as a senior director with a regional private equity firm and as an associate director with a Big Four accounting firm in the UAE. Nikhil is a member of the Institute of Chartered Accountants of India, a certified chartered financial analyst, and a postgraduate diploma in business administration from ICAI Business School. Welcome on stage, Nikhil.
So first of all, thank you so much for your time on coming on a Saturday morning to hear us on the topic of mergers and acquisition and business valuation. So really appreciate that on behalf of all the speakers. I'm going to talk about fundamentals of mergers and acquisition, and I think Ramesh has set the stage very clear on that. I'll start with a one simple question to all of you, and you can make a wild guess. How many companies fail to deliver value creation for shareholders post-acquisition? Out of the M&A transaction which happens, any percentage you want to guess? Absolutely. I think you all know it. So 70 to 80% of M&A transaction fail to create value for the shareholders. But still, people want to go ahead and companies want to go ahead and acquire businesses or sell businesses. So let's dwell into the fundamentals, and I'll just talk about some of the reasons why companies would go ahead with the transaction. So what I want to cover in today's discussion is the motives, the drivers of an M&A transaction for both buyers and sellers' perspective. I think both of them have their own view about what they want to do, why they want to do an M&A transaction. Secondly, I want to talk about some of the ways how we can create value for the companies from the transaction. There are certain ways why the companies want to create value, and I think we'll talk about that. Following that, I will talk about transaction structuring, the way purchase consideration are paid out for the transaction, and lastly, the prerequisite for a successful transaction. Let's start off from a buyer's perspective. Why would a buyer want to look at a transaction? And this is, I'm talking about a corporate looking to acquire another business. First, primary is growth. I think all companies want to demonstrate growth, be it a listed or be it a private company. They want to demonstrate growth. Now, growth could come in the form of either organic growth, which means that you push your sales team, you get new contracts and grow on a year-to-year basis, and open offices in other markets and help expand on a normal basis. That's organic growth. You could do that, but the speed would be limited because you could do the limited things in a year. But the other way is to look at inorganic way to grow, by which you could go and acquire a business and you can easily double up your business. I will just want to talk about some examples about it. I think we talked about Uber and Careem, two ride-hailing apps in this market, both growing. Uber wanted to really grow fast. I think they went and acquired Careem and became the largest ride-hailing app in the country. Another example, Walmart acquired Flipkart about in 2016. Walmart had a strong presence in the back-end logistics and supply chain support, but they never had presence in the consumer-facing business. They had an opportunity where the shareholders of Flipkart were looking to sell the business, and through an auction process, they went and acquired, and they could easily grow their business in the consumer-facing business. So that's was a straightforward objective for Walmart to go and acquire and go into a new market with higher revenues and sales. Looking at another motive, the buyer could, or a company could look at acquiring a particular trademark or a product which they don't have, and they believe that if they acquire a particular product, they can create value for the shareholders. Clear example, Apple. Apple acquired the modem business of Intel because Apple knew that they do not have this capability, and if they had an in-house capability to build modem for their iPhones, they would have a significant competitive advantage, and they could actually drive revenue as drive profits as well for the business. So they went and acquired in 2019 the modem business of Intel. Talking about Another example, buyer being a cash-rich business, what do you do with surplus cash? Yes, you've paid dividend, that's one way to look at, but then you can go and acquire another business to grow and expand. Reliance Industries have been exploring to grow in the retail space. They went and acquired Hamleys retail toy store so that they could add value for their retail business who were expanding. And it all could happen because they were sitting on cash. Financial returns, I think this largely applies for a financial investor or a private equity firm who would deploy capital to generate returns for their shareholders or their VC funds or their LP funds. Again, very local example, CVC Capital in 2019 acquired a 30% stake in GEMS Education for the sole purpose of generating financial returns with an objective to exit the business maybe in a 3 to 4 years' time. GEMS Education has already had 2 rounds of private equity investors previously. So again, I think CVC Capital said that since if 2 investors have made returns, possibly there's an opportunity for them as well. Eliminate competition. That's an important motive again for the buyer's perspective to eliminate competition and consolidate the market. Talking about a few examples, Aon, one of the leading insurance brokerage firm in US, made an attempt to acquire Willis Towers, another number 3 player in the brokerage space. Unfortunately, the US competition court declined the transaction, but there was still an attempt to eliminate competition through an acquisition. So they can become much larger and dominate the market. These are some of the buyer's motive in terms of why they would want to enter into a M&A transaction. Largely, it would say is the growth, it's the return which drives them to undertake a transaction. I just want to talk about a bit on seller's perspective. They have a different view and a different drivers why they want to enter into a transaction. Non-core, one of the key factors for them to being the non-core. I mean, you've seen a lot of large conglomerates have multiple businesses. I mean, there are large, there are small businesses. As part of the strategy, they may determine that there are certain sectors which are non-core, where they can't really focus attention, can't devote time on that, and they would identify that, and that will be a classic case of a non-core asset being sold out. For example, Tata Group, large conglomerate, had a Lakme business, which they found that it's too small for them to really focus on, and they said the best would be to really sell it to another competitor, another player who can really take it to a different level. Hindustan Unilever Limited were building their FMCG platform, and they said perfect fit for them, so it was sold out. Distress, liquidity issues, again, a primary factor for sellers to look at, because there are, again, various businesses, and if they can encash or sell some of the portion of the business, they could generate liquidity for the core business, which they can drive focus on. Reliance, classic example, Reliance mutual fund was sold out to Nippon because they wanted to generate liquidity for other businesses, and they executed the transaction. Cash out, maximize returns. Again, this applies largely to the financial investors, like we saw CVC Capital from the buyer's perspective. Once they have built the business, they will want to cash out and maximize their returns. Another example, local example, TVM Healthcare. Actually, they established Cambridge Medical Center a few years back, built the business up, and when they reached a mature stage, they sold it to Amanat and generated returns for their shareholders. Leverage issues. A lot of companies would have highly levered balance sheet. The best option for them is to sell a portion of debt out or sell a portion of cash generating business and delever the balance sheet. Future Group sold the Pantaloons business to Aditya Birla Group. Clear example of balance sheet being highly levered. How do you manage going forward? You actually exit some of the businesses, generate cash, and delever your balance sheet. Few others, Shareholders Dispute, No succession planning, shareholders dispute. I mean, if there are multiple shareholders in a business, they don't see eye to each other. I think either you leave the business to really collapse, or the shareholders need to decide that either one buy the other out, or they collectively sell and resolve the dispute so the business can continue in future. Succession planning, again, the first generation has set up the business. The second generation really don't want to carry on the business. They are focusing on their own businesses. Option is, let's sell the business, generate cash for the shareholders. These are primarily some of the drivers for the sellers to really undertake a transaction. Another important slide, I think we talked about that 70% of the companies don't create value, but it's important to look at what are the things which both the buyer would look at to create value for the shareholders or for the company combined together. And it's important to look at each of these. This purely lies by looking at the financials of the business. Talk about the first, it's the revenue synergy. I mean, and it's important to analyze these strategies or these synergies prior to executing a transaction, because you do not want to end up acquiring a business and then scratching your head to see what synergies we can extract. It's important to look at these synergies beforehand when you're executing the transaction in the process of your due diligence phase. So in terms of revenue synergies, look at the way you combine the business, how you can cross-sell your products. If you're looking at a particular target which has got an operations in, let's say, nearby country where you do not have an operations, you clearly see a synergies where you can cross-sell your products. You can leverage your sales team. You do not need to duplicate the sales team. You need to consolidate and bring synergies out of it. Reduce competition, for sure. If you're merging two companies in a similar space, you can drive the revenue synergies. So important is to analyze what synergies two businesses can create once they are put together as part of your due diligence phase. Cost synergies, increase in production efficiency, how you can really put them all together and drive efficiencies in production. Basically merge your marketing, R&D teams. You can really reduce cost big time. Leverage your logistics capabilities. Important, I think the objective of an M&A transaction is how you can drive your sales up, how you can actually reduce your costs so you can expand your profitability. That's where we ultimately, the objective for any company to acquire is to look at these aspects. And it's important that you analyze this in detail prior to transaction. Asset synergies, combining the production lines, use the technical know-how of each other's, look at the efficient working capital sides. I think important is, again, looking at the balance sheet side of the two businesses together, how you can really effectively utilize the assets, the production facilities. Financial synergies, important to look at, how the two businesses put together can reduce cost of capital. There's also an opportunity where you put together could be easily access to future expansion, future capital raise. And also you need to look at the efficient capital utilization. So these are largely, if you look at the revenue and the cost synergies, comes from your analyzing your P&L and the asset and the financial synergies largely for a balance sheet. It's core that you need to analyze this, and a lot of companies do not do that, and that's how it doesn't create value for the shareholder. So it's important as part of the due diligence process that you undertake a synergy benefits, what can be created out of the two companies put together. Talking about a bit on the transaction structuring, I think largely talks about the secondary and the primary transaction. On the secondary transaction, I think there are two ways to actually structure it. You could actually do a share purchase, or you could do an asset purchase, depending on what's your need is. As far as the asset purchase is concerned, the buyer would acquire shares from the sellers and pay cash or consideration, but they will assume the proportionate ownership of the assets and liabilities. As far as asset purchase is concerned, the buyer would just buy the particular asset and not take over the liabilities, because as part of the due diligence process or as part of the requirements, they will realize that there's no point in taking over the liabilities because you do not know what could come in the future. So they would just carve out the asset and buy the asset. It could be a bit complex process, but in certain transactions, it's worth going through that route, despite it being transact, because you need to enter into various different agreements. You have to do a lot of deep dive in terms of numbers to clearly identify the asset and the related components to those assets to acquire. Primary transaction largely is basically issue of shares. Basically, the buyer would actually give money into the company rather than to the shareholder. And in lieu of that, the company will issue shares and they will assume proportionate ownership to the assets and liabilities. As far as the secondary transaction goes, the money is in the pocket of the shareholder rather than the company. Another important aspect, mode of purchase consideration. How do you really pay the purchase consideration? Yes, the simple answer is pay cash. Buyer will purchase the asset or the shares and give cash to the selling shareholder. Straightforward structure. Again, Amazon acquired Whole Foods for $42 per share, paid cash. Another way is to basically have a share issuance where instead of cash, you actually, the buyer will issue its own shares and make the selling shareholders a shareholder in the buyer, which could also be a merger kind of a transaction. Again, talking about example, and BAT acquired FGB, and they actually issued shares in NBD to every shareholder of FGB. Pure shares-based transaction, no cash involved. Or a combination of cash and shares, where a proportionate value or the purchase consideration is paid in the form of cash and in form of shares. Example, Facebook acquired WhatsApp and partly paid in cash and partly in shares. These are largely the three forms of purchase consideration. Moving on, I just want to talk about some of the prerequisites to achieve a successful transaction. Define clear M&A strategy. I think Ramesh mentioned this very clearly, that both buyer and the seller needs to have a very clear defined strategy in terms of what companies they want to acquire. You could define a particular sector, you could define a particular geography, you could set up a threshold in terms of what stake you want to buy. You may not want to be interested in buying 100%, you could look at majority. So you need to have a very clear defined strategy in terms of acquisition, because if you do not have a clear strategy, you'll become very opportunistic and you look at each and every transaction which may not be productive for your time. So it's important to have a very clear defined strategy coming from the board, coming from the senior management, and the team can work towards that. Strong corporate governance, again, very important aspect. It needs to be clearly laid out for both buyers and sellers' perspective, because the decision making needs to be smooth. And it should be straight away coming from the board. Board needs to be aligned with the senior management, so that when you are executing a transaction, it becomes a very smooth process. Robust business plan. I think from a seller's perspective, it's important that when you are approaching a particular investor, the primary factor would be from a buyer's perspective about, can you share a business plan? And we have seen time and again, management will put together a business plan without putting enough thoughts on it. But it's important to have a very robust business plan, because that will demonstrate the view of the management about the company going forward. So I think it should not be done in a short process. You will need to really think about what plans you want to do in terms of what new products you are going to launch, what new markets you're going to focus on, what strategies are being adopted from the company's perspective. So it needs to be thought through, needs to be spent time. So a lot of preparation needs to go in terms of preparing the business plan. which should withstand the diligence, because you will have advisors on the other side, which will be commercial diligence would be required. So it should withstand the due diligence. Strong management team, again, is important. In any M&A transaction, both buyer and the seller, management team has to be fully aligned. They need to really invest the significant amount of time. The decision making is important. So it's important to have a very strong management team who would drive the M&A transaction. Again, drives is robust accounting and IT systems as part of your due diligence process. You need to share a lot of information with the due diligence advisors on the other side. And if you have a very robust accounting or an IT system, they would be able to pull out a lot of details. I mean, we've done a few transactions in the past. Just to give you an example, we had 2 transactions running parallelly. On one side, we had a very strong management team with very efficient process. We could complete the entire due diligence within a 4 weeks' time. On the other side, on another transaction, we had systems in place where the management was not able to pull out the required information and share it to the requirement of the due diligence advisors. And it took about 8 weeks plus to actually go through the due diligence process. So you could have these issues, so it's better to be planned ahead. Strong market reputation, important for both buyers and sellers, that the market reputation has to be strong. It's important a lot of times in due diligence, you take feedback from your customers, from your suppliers about the reputation of the target companies. You actually go and sometimes you go and talk to banks to understand their reputation about, are they paying off the bank on a regular basis? Is there any default? It's important to have that. And wherever a buyer would see there's a credibility issue with the target companies, they can always back off. Reasonable valuation, again, that's one of the challenges all the advisors face. And I think that, it's advisors' role to manage this particular element in terms of, you will always see that the sellers wants to get the moon, whilst the buyer is on the ground saying that, no, that's not the real value is. So it's important to have a reasonable expectation on the valuation, which advisor, we believe that this is the right value for the business. A transaction is always, it should be a win-win for both parties. It cannot be a win for one of the parties. So it needs to be ensured that there's a reasonable balance maintained between the valuation from buyers and sellers' perspective. Efficient capital structure. Again, I think the target company needs to evaluate, or the advisors need to evaluate the right capital structure for the company. And if they feel that either it is too levered, highly levered, it could become a challenge for a transaction to be executed. In that case, what needs to be done is to look at ways where you can deleverage the balance sheet. Either you carve out the debt and move it to a separate vehicle, or you leave it at the holding company level and have a very clean structure which the buyer will be able to appreciate the value for a business like that with an efficient capital structure. Thorough diligence, needless to say, I think I've never seen any transaction which has been completed irrespective of due diligence being haywire. Due diligence has to be thorough. I think there'll be multiple advisors appointed across, legal, financial, commercial, tax, operational, a lot of diligence will be there. So the business should be geared to sail through the due diligence process. If you fail a due diligence, I mean, very unlikely that you would complete a transaction. I think these are some of the prerequisites of a successful transaction. I have a few slides on transaction process. I think we've already covered, so let me just skip some of these slides, and I will just jump on the last slide about hurdles. I just want to talk about some of the hurdles which could impact M&A transaction. Price expectation, I think we talked about it. This is the primary factor, which needs to be looked at. Important to find is, I think Speaker will talk about the business valuation. I feel the valuation is an art rather than a science. There are certain techniques to do a valuation, but it's limited to that. Ultimately, it's the art and it's the way one perceives about the future. There could be individuals where I could be very optimistic about the future, about a particular product's future, and I would value it that way. Whilst I could have another person who completely believes that this product is going to fail, and he will assign a value based on that. So it's a very delicate scenario, and I feel it's always an art than a science. And I think it's important when you're executing a transaction and as an advisor, you need to make sure that the valuation expectations are kind of met from a buyer and seller's perspective. Lack of sellers advisors. It's important that if you're trying to sell a business, get an advisor on board at the earliest, because there is significant amount of time which goes in terms of preparing the company for sale. Management is best should be left to run the business rather than run M&A process. Key management continuity. A lot of times the company is buying target because they believe the management team is strong, and it's important to ensure the continuity of the management team. I think there are times where the management wants to exit, and I think sometimes it's important that the sellers make sure that the management continues on, and you could work out various different structures with them in terms of bonus scheme, in terms of incentive-driven schemes, but it's important to have continuity of the management going forward, and especially when you're buying a majority, 100%, and it's important that there has to be a hand-holding process, which could be between 2 to 3 years' time, so that the business continues on with the new owner. Poor MIS and adequate preparation. Again, we talked about it's important to have the robust MIS systems in place. So if a company is planning to sell a business, they should really start thinking a year before they actually going to the market. Third-party consents. This becomes important as we move towards towards the end of the transaction process, where certain CPs have been identified as part of the transaction agreements and needs to be complied with. It could be as good as getting clients' consent, getting suppliers' consent. If you have very key customers, it's important that you get the buyer would want to make sure that the continuity of the client is important. So they'll put a clause related to getting the consents. Getting consents from banks is again important, because you would want to have that the banking facilities continues on going forward. So these can become an important aspect, and if any of these third parties do not provide a consent, it could actually lead to a walkout of the transaction from a buyer's perspective. Legal structuring and regulatory process. A lot of times we've come across that the companies have multiple entities in different jurisdictions. They do not have a common structure. That could lead to a lot of delays. So it's important to get the legal structuring and the regulatory process laid out very clear and upfront, so that you do not feel hurdles later on. Poor project management. It's M&A process is a project which needs to be really closely project managed, and we have seen a typical successful transaction takes between 6 to 9 months of efforts from the buyer, and typically I'm talking about a sell-side advisor's perspective from the time they start off. That's the minimum time required, which means that they need to have a third party to really manage that process efficiently. There are certain timelines which are drawn on for each phases and needs to be maintained accordingly. Deal fatigue. I think we briefly talked about deal fatigue. Typically, as I mentioned, 6 to 9 months is to get deals closed, but we have seen time and again then the deal flows more than a year, 18 months, and at some point it becomes a deal fatigue for both advisors at the buy side, sell side, the management team, and we've seen a lot of times that deal fatigue builds in, and both parties want to walk out, that let's focus on the business again. I think that's about my presentation. I think I've just listed some of the projects which we have done. We've done across buy-side advisory on retail fuel operator in the UAE when they were acquiring targeting Saudi. We've done some land surface logistics companies sold to a leading port operator, large industrial catering business sold to a family office, salon business. We have sold salon business and a bit on the retail space. That's it. Thank you.
Thank you, Mr. Nikhil. Thanks for the insightful presentation on fundamentals of M&A process. Uh, can I request committee member CA Anu Thomas, past chairman CA Prakash Mehta, senior member CA Anil Kejriwal to present a memento to the speaker.